I want to focus on the bond market right now. And first of all, I want to get your thoughts on comments suggesting that we should see yields trend lower over the rest of this year. How low do you think yields could get? Because we've seen quite a number of bonds lose as much as 300 basis points over the last few months.
Correct. Hello, Wole. Thank you. Yes, I think that there is still a bid being built up in the international market for bonds from Nigeria.
Right.
At the time that the JP Morgan index admitted Nigeria to the index, longer term yields were upward of 15%. They've now come down to just, in the high 12s, early 13s. I can see them going a little lower, but I can't see them going a lot lower than that. I'd be surprised.
We're getting to that sticky point right now.
Yeah, I'd be surprised to see them break 12%. I think
clearly, if they are going to break 12%, what is going to drive that most likely will be the foreign investor interest. And we'll be trying to get your thoughts on what the authorities in Nigeria need to do to keep that interest going, because clearly this is on the back of the improved liquidity we've seen over the last few years in Nigeria's bond market, but I think a lot of people are expecting a lot more in that respect.
Yeah, the most important thing is liquidity. I mean, these people, although the bond now being in the index gives some permanence to their positions, they're still going to want to be able to trade in and out of the bond. And they're going to take a very dim view of any market that they can't get out of a government bond that they have bought. Therefore, the primary dealer, PDMMs, are going to have to ensure that the bonds that are in the index always have a market being called on them.
What's the status of the primary dealers and market makers right now? What's your view on that function? Are they making markets on bonds, or is it more of just some estimates on where bonds should be trading? Or are we actually seeing real calls on bond prices?
There are real calls on certain bonds. There certainly are not calls on the whole curve,
right,
which under the original arrangement with the PDMMs and the DMO, they were supposed to call markets on all issues that were brought by the government. They're certainly not doing that. They're calling markets on a series of bonds which goes up and down in number depending on the volatility in the market and the direction of the market. Now that the markets are bullish, more dealers are prepared to call markets in more bonds. As normally happens when the markets get bearish, a lot of the dealers pull out of the market completely.
In your view, is there a risk that we'll see bond prices fall dramatically, or do you think in the worst case scenario we'll probably see bonds where they are now?
No, I think that as long as inflation stays relatively under control, and as long as the MPC is happy to leave interest rates where they are, then I think we have a fairly reasonable equilibrium in the bond prices right now where they are. However, we have two inflation events around the corner. The first one is Christmas,
right,
where inflation normally rises for a couple of months. And the second thing is that we haven't yet paid for the floods, right, which is certainly going to be inflationary. We haven't seen it turn up in inflation numbers yet. We don't anticipate it this month either. We anticipate that those numbers will start to rise next month.
Very good point you're making on the impact of the flood and what it could mean for bond yields. But the last point I would like to get your thoughts on is on this whole expectation that we need to have some bonds switched in sometime next year. And maybe you can reiterate the point, because I don't think it's been discussed recently. I think there were some thoughts about that, some suggestions that the DMO may be coming out with a view on that, but we haven't heard anything in the past few months.
Well, the market keeps talking about doing a bond switch so that the DMO doesn't have to actually mature the bonds and
right,
then reissue, that they would just switch bonds for existing tenors. My belief is that the bonds are held in a small enough number of hands that switch could probably be done reasonably easily. I don't see it as being a huge problem if, as and when the DMO wants to do it.
So in your view, even if we don't see action on this until perhaps a few months before those bonds are due to mature, you don't think there's going to be any reaction in the bond market?
Well, if it's a few months before, then they will, because those bonds will then be considered to be money market securities.
Right.
And the DMO will then be switching money market securities for longer term positions. At that point, you could see some pressure on bond yields out in the 3 to 5 year area.